The number one financial regret of women is that we don't invest enough, which is why I wanted to read this book. So this is Girls Just Want to Have Funds. See, like a play on fun, funds. Get it? Okay. A feminist guide to investing. So based on the title of the book, obviously this book is catered towards women. And there is a big portion of the book that talks about like why women especially should be investing, but an even larger portion of this book is just explaining what investing is and why you should do it and how you should do it. So this book is definitely beneficial to anyone who wants to read it, and it's going to be our first book that we're reading here on the channel. So throughout this year, we will be reading a book once a month, and this is the first one that we're starting with. If you want to help decide the book that we'll read next month, leave some comments down below and tell me what your suggestions are. Okay, so if you can tell, you see all these? See all these? I have been studying this book. I've been highlighting stuff, bookmarking things. There's a lot of value in this book. So for this video, I'm just going to talk about the biggest takeaways that I got from the book. And I have my iPad here with all of my notes. So let's get started. Okay, so why specifically should women invest? First, there's this thing called the gender wage gap or gender pay gap. On average, men make more money than women. In fact, globally, 42% of women aren't even in the paid workforce at all because they are at home doing unpaid, largely invisible work like cooking, cleaning, taking care of kids. And even if there is a 10% pay gap, that can lead to 38% less wealth by the time you reach 65. So for example, if a man has $1 million by the time he's 65, a woman is more likely to only have $620,000. So a huge difference. There's also the gender wealth gap. So that talks about net worth. So statistically speaking, women are going to have more student loans. We're going to have our mortgages denied more frequently than a man will. We're going to have higher interest rates. And we're also going to receive lower quality financial advice. So ladies, like even if you go to like a professional personal finance advisor, statistically, you are more likely to be advised to save money, and men are more likely to be advised to invest money. The book also talks about something called financial confidence and how women need more of that. So financial confidence means things like awareness of how money is a tool to get you things that you want and need. Also financial literacy and just the trust and knowledge of where to ask for help. And this is how you can increase your financial confidence. Number one, build up your money skills. Read books about money, watch YouTube videos about money, listen to podcasts about money, talk to your friends and family about money. Just try to be more financially literate. Also, it talks about reclaiming your financial identity. So basically, like, what do you tell yourself about money? Like, are you constantly saying that you're bad at money? Because the more you say something, the more you believe it. So stop telling yourself like all these negative things about yourself and how you handle money. Instead say like, I am actively trying to get better at money. I am taking steps to learn more about money. So just have like a more positive mantra when it comes to how you manage money. Another way to build financial confidence is to set a financial goal and then actually reach that goal. So the big thing is actually like reaching it so that you can do like a check mark and say like, yes, I actually did this thing. So like, for example, if you say like, I want to lose 15 pounds in 3 weeks, that's ambitious. You may not get that, or you may not do that. And even if you do it, you probably didn't do it in like a healthy way. But if you said, I want to lose 15 pounds over the next 15 months, that's actually a very doable goal. It's very achievable as long as you are consistent and disciplined, right? So use that same mindset when it comes to your financial goals. Don't set a goal that is completely unrealistic. Set an achievable goal. And what's achievable for me may not be achievable for you, and vice versa. So it really just depends on your own personal financial situation. Another way to be more financially confident is to avoid lifestyle creep. I have fallen victim to this myself, but don't be like me and avoid lifestyle creep. So think about like how much you make in an hour. And then if you want to buy something, think like, is this worth an hour of my time? Is it worth 2 hours of my time? Is it worth 3 hours of my time? Think about it in like payments, I guess, of time. Like, would I feel bad if I spent an hour doing a service and then this is what I got in return? Also, don't be afraid to ask questions. Sometimes we don't want to ask questions because we don't want to look dumb, but actually, like, if you are given knowledge about something and then you don't do the thing that you were advised to do because you didn't understand it, and then like your teacher, if we want to call them that, like if your teacher then finds out that you didn't do the thing and they ask you, why didn't you do this? And you're like, well, I didn't understand it. And they're like, why didn't you understand it? And your response is, I didn't want to look stupid. That in itself looks stupid. So don't ever be afraid to ask questions and tell them to break it down to you. Tell them to break it down to you like you are 5 years old. There is no shame in asking questions. Another thing that the book talks about is budgeting, and how a budget isn't a punishment. It's really just a way to make sure that you're spending your money in the way that you intend to spend your money. So you want to know your income and your expenses. There are fixed expenses, so things that are the exact same every single month, they're not going to change. And then things that are variable expenses, like things that do go up and down. One popular way of budgeting is the 50-30-20 rule. So 50% of your income is spent on necessities, 30% of your income is spent on fun things, and then 20% of your income is spent on future you. So that is a mix of saving as well as investing. So the book also introduced the concept of having an FU fund. Think like a vulgar word and then you. So it's basically like an emergency fund, but it's theirs to give you the power of choice and freedom. So you build up this emergency fund, this FU fund, and now you have the opportunity to, like, if you get laid off from work, you won't panic immediately. Hopefully not. Hopefully that doesn't happen to you. But if it does, you have an emergency savings. Or like maybe you just hate your job, like you really, really hate it and you want to quit. If you have this money stored away, then it gives you the freedom to make the choice to quit if you actually want to. And then with this concept of your future self, as when it comes to debt, there's good debt and then bad debt. So good debt is anything that creates value for your future self. Think like a mortgage. Bad debt is anything that doesn't bring value to your future self, such as credit card debt. And if you've been watching my videos, you know that I am in credit card debt, and that's something that I am aggressively trying to get rid of. One last thing that pertains to women especially is money and relationships. So globally, this is a worldwide issue. Most women in heterosexual relationships take a backseat to finances. So statistically, only like 20% of couples have equal financial decision-making power. So that means 80% of women who are in heterosexual relationships don't have power in their finances with their spouse or significant other, which is scary. I'm single, so I can't really imagine that. So I'm just like, so what do you mean? Like you're in a relationship and you just don't talk about money? You just don't ever talk about it? Y'all don't make decisions together? Like, that's weird. That's weird to me. Future husband, just know you not getting one of those type of women who not gonna ask questions, because I'm gonna be asking questions and I'm gonna want to be involved. Future husband, if you're watching. Another really like sad statistic is that 80% of women are gonna die single. And by die single, they mean like, yeah, there's women who just never get married or never get into like a long-term relationship, but also women who have been married but are now divorced, or women who outlive their husbands. And so if you find yourself in a situation where you used to be in a relationship and now your husband or boyfriend, they're no longer here, do you know what would happen to you financially? Do you know where all your accounts are? Do you know which banks y'all use? Do you know how many accounts are in each bank? Do you know the passwords to these accounts? Do you know how much debt you're in? Like, imagine you outlive your husband, you're heartbroken, and then you find out that y'all actually have like $50,000 worth of debt that you knew nothing about. Ladies, ladies, do not do that to yourself. You need to have these discussions with your partners. Y'all need to openly talk about these things. And it doesn't matter who is working and who's not. Like, you have to be really careful about power dynamics when it comes to things like that. Like, one person may work and one person may not. One person may make significantly more money than the other person, and it tends to be like whoever makes the most money, they tend to be the ones who make the decisions. But y'all need to remember that y'all are a team. You are on the same side, and y'all should have equal decision making power in your relationship. Now let's just talk about investing. So, no matter male or female, this is investing advice to anybody. So, what is investing? Technically, anything that you buy with the intention of selling at a higher price can be considered an investment. So, a house is an investment, art can be an investment, cars, watches, purses. So all of those are different types of investments, but this book focuses mostly on stocks, funds, and ETFs. So let's explain what those are. So stocks. Envision like a farmer's market, and you have buyers and sellers that are trading things. And if the demand of something is high, then the price of that thing will go up. Stocks represent ownership. So if you own a stock, you own a piece of a company, usually like a very, 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 very small piece of the company, but still a piece of the company. And stocks is more of a like generalized term. And if you've ever heard of people saying shares, shares are usually stocks for one specific company. So I can own a variety of stocks, or I can have shares in Apple. And there's two ways that you can make money from stocks. One, the price of the stock increases, or like the value of the stock increases, or stocks can pay you dividends. Dividends are payments that the company pays to its shareholders or people who buy their shares in that company. Okay, so that's stocks. Now let's talk about mutual funds. Mutual funds are when a group of investors come together and they all make the same or mutual investments in something like stocks or bond. So this time envision like a bag, like a paper bag or a cloth bag or whatever, any type of bag you want really. But the bag is filled with coins. So the coins would be stocks or bonds, and then the bag itself is the mutual fund. And the value of that mutual fund depends on the performance of the securities or investments that it buys. And then like a subsection of mutual funds are index funds. And an index fund, that just means it tracks the performance of a certain type of stock or like an entire country's stock market. Then last but not least are the ETFs. ETF stands for Exchange Traded Fund. And this is a type of fund that follows an index, which we just talked about. And when you're investing, it's really important to know your risk and then your time horizon. So risk means, okay, so like bonds are low risk and individual stocks are high risk. So bonds are usually like the older you get, the more you would want to invest in bonds, because bonds, they don't really go up and down. They don't fluctuate in value a lot. They're a lot more stable, which means they're not as risky. But stocks, like in one individual company, like if you're buying shares in one company, that would be really risky, because what if that company fails? Then all of your stocks would drop. So that would be a high risk scenario. And then when it comes to your time horizon, that just means how long do you have to invest? Because with investing, eventually you want to take the money out. Like however much you made in the investments, you want to take that money out so that you can actually use it, right? So if you are 20 you have decades to invest. So you have a really long time horizon. If you are 60, you probably, hopefully, will be able to retire pretty soon. So you have a really short time horizon. The longer your time horizon is, the riskier you can be. And, vice versa. The shorter your time horizon is, the safer you want to be, because you don't want to make a lot of like risky investments and you need that money in like a couple years. So you want to be really safe with your investments so that 2 years from now, 5 years from now, you can take that money out and, there's a high chance that the money will still be there and you didn't lose money right before you needed to take the money out. Another section of the book talked about the 6 golden rules of investing. Let's talk about them. 1, buy and hold. That just means when you buy an investment, don't turn right around and sell it. You need to be buying for like the long haul, long-term investing. Just buy it and let it sit there for years, decades even, until you are ready to take the money out. Next, invest gradually. So you may have heard something called dollar cost averaging. So that just means like, okay, so now is January, right? The beginning of the year. Some people may want to max out their investment accounts right now. So like whatever the max amount for an IRA, an individual retirement account, I don't actually know how much the limit is. I think it's like 7,000 something. Some people who have a lot of money may say, I just want to max it out right now and I'm going to put in all $7,000 and I'm going to do that today, January 1st. While that's great because they've maxed out the account at the very beginning of the year, but that means they bought everything at one price. Whether it was high or low, they just bought it all on the same day. But if you invest gradually, or the dollar cost averaging, that means that you are investing in small amounts. So you do $200 a month every single month. Then that means sometimes you're buying it at a higher price and sometimes you're buying it at a lower price. But since you just keep doing it consistently, everything will kind of just even out. Next, you want to diversify your portfolio. That just means don't invest all in the same thing. Don't put all your eggs in one basket. Don't put your life savings into one company because you never know what's going to happen with that one company. Like what happened to the people who put their entire savings into Circuit City? Or everyone who put their entire life savings into Party City. Like, if you don't know, Party City is going out of business, right? So you don't want to invest in one thing and one thing only because you don't know the future and you don't know what's going to happen with that one thing. So instead, diversify your portfolio. Invest in healthcare, in energy, in tech, in education, whatever. Not just American markets. Invest in the global market. Invest in like European funds or whatever. Diversify your portfolio so if one takes a hit, it doesn't affect your entire portfolio. Also, you want to do your homework or research. Like research which companies or funds that you want to invest in, and just like a rule of thumb, invest in things that you think are going to be successful or invest in things that you are passionate about. And you also want to decide, when are you going to sell? So how long are you going to hold on to this thing? Remember when we talked about buy and hold? Before you even invest, you want to know how long you intend on keeping this investment. And the last golden rule is to be critical. Don't take financial advice from just anybody. Like, especially if someone who is like, hey, you should invest in this thing. You should invest in this thing. Does this person benefit from you investing in this thing? If so, maybe you don't want to invest in them. Like why are they pressing you to invest so much into this one thing? So just be critical, and that kind of ties into doing your homework, but know what you are investing in. So those were the golden rules of investing. And now, just like kind of a summary, these are the things that you should do before you even start investing. Know your own personal financial situation, create a budget, and already have an idea of how much you can invest. Know your money goals for the future. Do you want to just, you just want to get by in retirement? Like you don't want anything fancy. You just, want to be able to pay your mortgage, a little pleasantries in life or whatever, but you're not asking for much. Or do you want to be balling out in retirement? Because you're going to need two different amounts in order to retire. So know what type of lifestyle you want to live in retirement. Do a lot of research into your company and understand their retirement accounts or investment accounts before you sign on to a new job. Understand their 401k if they have one. Understand what their company match is, because those things can really help add on to your overall investment portfolio. Understand the basics of investing. Hopefully this video has helped you understand investing a little more, or for the people who actually read the book with me, hopefully you all got a better understanding of investing too. Like I mentioned before, know your risk and your time horizon. You also want to already decide what trading platform you want to use. And by trading platform, I mean like Fidelity, Vanguard, things like that. And then actually set up your account. Once you set up the account, then you want to transfer your money into the account and then decide which company or funds you want to invest in. And before you buy that stock or that fund, like I said before, already know when you want to sell that investment. And so once you've started investing, things are going along, you're investing consistently every month, you want to make sure that you're doing some maintenance on your investments. So every 3 months, once a quarter, you want to check in on your investments. So it's January right now. It'd be a great time to look into your investments and see how they're doing. And you don't want to, doing it like every 3 months is better than checking every single day, because every single day the market goes up, it goes down, it goes up, it goes down. And it can scare you if, you look one day and your accounts are down like 50% or something. And then it may excite you if you look one day and they're up like 50%. But neither one of those are like really true gauges of how your stocks are performing, because like I said, it goes up and down every single day. But if you're looking at it like every few months, then you can see like a bigger picture and you can see if like the line is going up or if the line is going down. And then once a year, you want to do an overall full deep dive into your investments. So you want to check and make sure, like, is my portfolio balanced? Do I have more stocks or do I have more bonds? You want to see like how diverse your portfolio is. Like maybe over the course of the year, one sector of your portfolio grew a lot and now it's not as balanced anymore. Or maybe your financial situation has changed. So maybe you need to decide, do I need to increase or decrease the amount of money that I'm investing every month? And the last tip is to remember that investing is a long game. Do not make emotional decisions, because like I was saying before, it goes up, it goes down. Now is not the time to be emotional. Now is the time to be patient and just wait it out. Just wait it out. And like I mentioned earlier, the younger you are, the more time you have and the more patient you will need to be. So those are my takeaways that I got from the book. I ended up reading this book in like 2 days. It's a very easy read. It goes by very fast. Like, you see, like it goes by really quickly. It's written in a way that's really easy to understand. And the things that I mentioned was really just a highlight reel. There's a lot of concepts that I couldn't get to in this video, because then this video could have been like an hour long easily. So even if you watch this video, I still suggest reading this if you have the time. So those are the things that I learned from the book. Anything that I missed or didn't talk about and you noticed in the book, please leave some comments down below. And I know that talking about money and especially like investing can be really intimidating, and you may still have questions even after watching the video. So like I was saying before, there are no stupid questions. So if you have any questions, leave comments down below. Maybe I know the answer, or maybe I don't, or maybe someone else can help us answer the questions. But yeah, I really enjoyed the book. If you like this video, leave a thumbs up and make sure you subscribe to the channel if you're not already subscribed. and I'll see you next time.